So last week you probably seen a lot of buzz around the topic that the yield curve in US has officially inverted. A lot of people were saying this is a huge deal because it has been a very accurate indicator of upcoming recessions. Now, I see a lot of different theories being thrown online, or connections being drawn. People were saying, hey, this is going to be a big one. This is where we're all going to suffer. It's a day of reckoning. Others are saying this is where it's going to be the big major housing crash we're looking for. So I thought this week it would be a perfect video to talk about the yield curve. What is it? How come it's a good predictor for recession? And why is it being inverted now? Now, before we start, if you could help us out, please help us like this video and also subscribe to our channel. If you haven't already, it will help us tremendously. Now, with that said, without further ado, let's jump into today's video. So first, let's talk about what is recession, because I think a lot of people actually don't have a clear idea what does recession mean. I find that usually when I talk to people, their definition of recession is more like depression, which is an entirely different and much worse economic stage than recession. So if we look at an official definition, let's take Investopedia for example. They said that a recession is a macroeconomic term that refers to a significant decline in general economic activities in a designated region. It has been typically recognized as 2 consecutive quarters of economic decline as reflected in GDP, in conjunction with monthly indicators such as rise in unemployment. Now, there are other alternate definitions as well. For example, according to the National Bureau of Economic Research, they said that it's more than just a drop in GDP over a couple of months, but also real income, employment, production, etc. So it's more than that according to them. But doesn't matter which definition you're leaning towards to, nevertheless, they're describing the same thing. A drop in economic activities over several months. Alright, so now we know what is recession. Next, let's look at what is a yield curve. So first of all, don't get thrown off by these jargons. It's not complicated at all. At the end of the day, they're just talking about interest rate on short-term bonds versus long-term bonds. So for those that don't know, when you buy bonds, you're essentially lending money to whoever you're buying the bonds from. For example, if you're buying government bonds, you're lending money to a government. If you're buying corporate bonds, you're lending money to that company. And since you're lending money, they will have to give you some sort of return, and that is the yield. So if you think about it, it works similarly to a GIC where you lock money away for a certain period of time and they promise you a certain type of return. And just like a GIC, bonds also have different durations. You can have 6 months, 1 year, 2, 5, 10, 20, 30-year bonds, etc. Now, why on earth would anyone lock their money away for a longer time by buying a long-term bond versus just holding short-term ones? What entices investors to do so? Well, the only reason they would do it is because the longer-term bonds offers a higher return. So just like a GIC, the longer term you're willing to lock it away for, the higher the yield would be. And if you plot all the yields versus the time you have to lock away on a graph, you get the yield curve. Now, this is what a normal yield curve would look like. However, when something weird is happening to the market or economy, yield curves can act differently, and where the short-term bonds actually give you a higher interest rate than the long-term bonds. So for example, you can see on the screen, this is what a normal yield curve looks like versus an inverted one, which is the one that we got in August 2019. And the key figure usually people take a look at is the 2-year versus the 10-year yield. So last week, when the 2-year bond yield is higher than the 10-year one, that's when we have an inverted yield curve, and that's why we're talking about this today. Alright, so the next question would be, why does an inverted yield curve have anything to do with recessions? Basically, the rationale goes something like this. When the yield curve is inverted, it's saying that the bond investors see a lower interest rate in the long run versus the short term. And the only reason why interest rate will be lower in the long run is because a recession is likely to happen. Now, another question we need to ask is, why is it inverted now? So according to a Fortune article, Anu Gargan, global investment strategist for the Commonwealth Financial, laid out 4 different reasons. And number 1 is the demand for long-term bonds in the pension fund. They had great runs in the last couple of years in their equities, and now they're looking to de-risk by selling equities and add more long-term bonds. Whenever demand for long-term bond goes up, yield drops. Now, second reason is US Treasuries are popular central bank for the world. due to US currency being world reserve currency, and also US treasuries are trading at a higher interest rate than government paper in most developed countries, so more investors are now flooding to the US bond market. The third reason is the Feds have massively been purchasing bonds for the last 2 years since pandemic to help push down the interest rate, hence it has pushing down the yield. And lastly, she argues that geopolitical conflicts makes US bonds a safe haven. And I'll add the fifth reason as well. I think it's also due to recent strong job growth in the US. This makes investors worry that Feds are going to increase rate at a 0.5% increment versus the 0.25 as expected, which will also help slow down economy in the long run. Alright, so now the yield curve is inverted, we also kind of know why it may be happening. Does it really predict recession accurately though? The answer is it does not predict 100% of the time, but it does have a fairly high accuracy. There has been 28 instances since 1900 that yield curve have inverted. Out of those, 22 of them had a recession to follow. Since 1995, every time inversion has happened, it has predicted 100% of the time, only with one false signal. It was even able to predict in 2019 August when it was inverted, and as we all know, pandemic happened the year after and a recession followed. However, I would say this is more of a coincidence because there's no way a yield curve or any tool on this earth will be able to predict a global pandemic. So while there's some sort of correlation that we can see, it's not a sure thing. But I would say that actually does not matter too much. It's the idea of recession that we need to focus more on. So next, let's talk about recession itself. And here what I want to focus on is recession really a doomsday scenario, or it's more of a natural and even somewhat healthy thing that should happen to an economy? I think it is a natural thing and it is not such a bad thing, and here's the rationale. In the past few years, what do we have? We have a lower interest rate environment, labor shortage, due to COVID, no traveling, lots of money being saved up per household, and with supply chain shock, which led to inflation, economy basically went into an overdrive. And due to recovery from COVID, most countries, for example US and even Canada, have a higher than usual GDP for the last years. So while the word recession sounds very scary, we have to recall the definition we first see in the beginning of the video. A recession is defined by 2 consecutive months of GDP drop. Well, if you think about it, we have been having higher than usual GDP for the last year. So it makes sense and it's natural that eventually we will have to return to our normal level of GDP. And that means a drop, which then will put us by definition into a recession. But this type of recession is probably very different from the type that we have in our minds, where everyone is out of jobs, they're all laid off, there's no one spending in the economy, bubbles are bursting, everything is just going down, down, down. And we have to be careful of this line of thinking because I see a lot of people put too much emphasis on these kind of indicators, the yield curve, and the word recession. And they're drawing unnecessary connections to what they want to happen. For example, I see a lot of people saying, hey, because it's indicating a recession is coming up, so stock market is going to crash. Maybe they want it to crash because they have been sitting on the sideline waiting for a 40% correction. We have to be very careful to what kind of conclusion we're drawing from these kind of indicators. Now, another thing to keep in mind is that the yield curve inverted for a short time only. You really want it to be inverted for a long period of time, like a couple of months, to truly be some sort of indication that a recession has happened. Moreover, just because it's indicating a recession may be coming up, we're not talking about overnight kind of thing. You're not going to wake up and tomorrow is a recession. Even if it's indicating it's coming, it could take as long as 12 to 18 months for a recession to arrive. So my point is, while these things are good to know and we should know all about them and why is it being inverted and why is it not normal compared to normal times, we should not make decisions or draw conclusions solely based on these kind of indicators. These kind of inversions do happen from time to time and they are short-term fluctuations, which should still stick to our long-term plan overall. So continue to invest in the companies that you feel confident in the long run. And buy a home right now if it's self-use and finance makes sense to you on budget. And if you're not going to buy a home, it should be because it doesn't make sense to you budget-wise. It should not be because some sort of indicator or yield curve is being inverted and you see it as a sign that the market is going to tank in 12 months and 18 months, and that's why you're holding on to a cash. I'm not saying housing market is not going to fluctuate or even drop, but it has to do with a lot of other variables, not just because an yield curve is being inverted. So that's why I want to talk about this week. I think it's an interesting topic to know about and also be aware of, so we're not drawing too much conclusion to it. Now, if you like what I'm talking about today, hit the like button once. If you don't like it, hit the dislike button twice. Now, next one I want to hear from you is, what do you think about this yield curve being inverted? Is it a big deal, or is it just a blip? It doesn't affect the outlook? Let me know in the comment down below. And if you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you like the video, subscribe to my channel, hit the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!